Okay, Bismillah Rahman Rahim. Good evening and Assalamu alaikum to every students for participating in this who are participating in this session. I would like to welcome you all. This is Muhammad Junaid Khalid, your course facilitator for F7 Financial Reporting paper. Okay, let's start with the session. And before we start with the session, first of all, let me discuss with you the agenda of this session, that why we are here and what we are going to learn in this particular session. So you must be aware of it, that what we are going to learn in that particular session. Okay, today we are going to have a question and we are going to solve the question that is related to final accounts, and at times it is also known as what preparation of financial statement, or it is also known as what single company account or single entity accounts. Yes, there are two sets of account that you need to prepare, that is the single entity accounts, the individual financial statement, and the second one is the consolidated financial statement. So we are here to learn the final account, that is the single financial statement. Now in this particular session we are going to learn that how to prepare the final accounts, how to basically attempt the final account question, how we are going to attempt that final account question in our exams, that is financial reporting paper. First of all, what my viewpoint is, what I think, what I perceive, that final account, it's not a separate chapter, it's not a separate topic, it's not a separate standard. It is something which is the part, or which is the summary of your whole course. Yes, I'm right. Which means that whatever you have learned in the different standards, all what you have to do, you just need to apply all of these to your paper now, to your final account question. Yes, that's the main thing that you need to remember. If you want to attempt the final account questions, which means that you must have a very strong grip in all of these standards that you have learned in your curriculum, from throughout your studies, like IAS 16 property, plant and equipment. It's very important, and you will see here IAS 36 impairment, IFRS 9 financial instruments, IFRS 16 leases, so IAS 12 income tax. So these are the standards that are very important for final account question. It means that you must have a very good understanding related to those standards, so that you can attempt the final account questions. Now, one more thing. Having said this, one more thing that you need to remember, that whenever you are going to attempt the final account question, or even the consolidation or the ratios, always remember, I always say to my students, two statements that I will give over here. Number one, it's impossible that there will be it's impossible that you will not be able to complete, or you will not be able to attempt the question. It's impossible. If someone says that it's I couldn't solve anything from that particular question, it's a false statement. It's impossible, this couldn't happen. There is something that you know, there is many things, even I would say there are many things that you would know, there are many things that you can attempt, there are many concepts that you know. It means you can't say this one, that I don't know anything from this question. And another statement that I would like to give, that no student, no candidate say this, that I know each and everything from this question. No, there is something, there will be something, there will be some adjustment, there will be some trick, there will be some part, there will be some element, there will be some transaction that you will not be able to attempt it. Okay, fine, doesn't matter. Remember that out of the 20% question, out of the 20 marks question, there will be 20, I would say that more than 50% area, that is 10 to 12 marks that you can easily secure. No one can say this one, that I can't secure anything, that I can't secure any mark from that 20 marks. That's impossible. It's a wrong statement. Please believe me. Believe me, I will read out the question. And that is the question from your official resource, from your ACC official resource. And you will see there are lots of things. There are many things that you will say that I know this one. Yes, I can do this. I can do this. But yes, there will be some part, there will be some adjustment that you might not know. Perfectly fine. Doesn't matter. If the examiner is giving you a challenge, okay, come on, try to solve this one. Just give me the answer for this one. And if you think that is impossible, now please show your attitude towards the exams. Okay, I'm not solving it. Who the hell are you? What can you do this? Okay, there is nothing to worry about it. If you can't solve any adjustment or any other one or two adjustment, it means you will be losing 3 to 4 marks or maximum 5 marks. So it means if you are losing 5 marks, so why you are panic? Why you are having a panic attack? Why you are having a panic attack for just 5 marks? What majority students does that they lose their 20 marks just because of those 5 marks. So because of that one adjustment, if you're not taking it, if you're not getting it, if you're not getting that particular adjustment, so what the students are doing, they are just spoiling up. What they are doing, they are just they're just spoiling up the whole question. Please don't do that. Whatever you know, whatever you are having it, whatever the adjustment, you know that how to tackle it, just try to tackle it. Try to secure the maximum marks. Please have some strategy. Please have some strategy to secure the maximum marks rather than the full marks. We will, hopefully, we will secure, inshallah, very good marks and 100% marks. But first strategy should be that you need to try to secure the maximum marks out of it. So now let's start with the final account question, and we'll see that how to attempt that question. Now there are different strategies that examiner might test you. First strategy is that the examiner will give you the data, and the examiner will ask you to draft the complete financial statement. To draft the complete financial statement like P&L or balance sheet. Obviously, either there will either be a P&L or either will be a balance sheet. So you have to draft the P&L or balance sheet. This could be one situation. The other situation is that examiner might provide you a draft profit or incorrect profit and will give you certain adjustments, and after incorporating those adjustments, you have to complete or you have to find out the adjusted net profit. You have to find out the adjusted net profit. So these are two possible ways. Okay, now let's try to read out the question and see that what is the requirement of this question. I hope that my question is visible to everyone. Please notify me that my screen and the question is visible to everyone. Please do let me know whether my screen and question is visible to everyone. And mainly, yes, we are also going to learn in that session that how to tackle the situation. This is basically the specimen. This is basically the real specimen of your paper. This is basically the real specimen of your paper. That how the paper will appear in front of you whenever you will sit in your exams. So it is the left side. It is the left side where the question and the adjustments will be given. And on the right side, definitely you can adjust the screen. On the right side, on the top side, there will be requirements. That what are the requirements? And on the right bottom side, there will be a response area. This is known as what the response area. That is the spreadsheet, that is spread file, the Excel file. There you have to respond to the question. So in this question, definitely we're going to learn that how to give the response, how to solve the question in that particular Excel file or on the examiner file. Now, first of all, let's read out the question. Let me drag the question area so that I can read it very comfortably. Let's read out the question. After preparing, okay, this is the question from your ACCA practice platform, and this is basically the practice exam 1. FR practice exam 1. You can definitely solve it. You can definitely open the file on your PCs or on your laptops. So this is the file. Okay. After preparing a draft statement of profit or loss before interest and tax, it means the company has prepared the income statement which is before interest and tax. Now, for the year ended 31st March 2016, before any adjustment which may be required. Okay, now it is quite clear that the adjustments which are given in this question has not yet been accounted for, which means there are basically 4 adjustments before any adjustment. These adjustments need to be accounted for. The summarized trial balance of Triage company at 31st March 2006 is. It means that is the trial balance which is given over here. Here we can see that the equity, that is the share capital, retained earning, and here we go. The important part is, or the important information that is given over here, that is the draft profit before interest and tax, which is given 30,000, which means 30 million. Now, convertible loan notes, and there are different account balances, and obviously the hint is given over here that for that you need to refer note 1, note 2, note 2. Okay, perfectly fine. Let's move on. This is the trial balance which is given in the question. Now, first of all, let's try to read out all the adjustments, and then we are going to solve those adjustments. First of all, Triage company issued 4 lakh $100 6% convertible loan notes. Okay, my goodness. Now, any one of you, can you please identify from which standard, this adjustment has been taken? Any one of you, can you please identify that from which adjustment, from which standard this adjustment has been taken? Remember, we are having this session, and in this session, obviously, we are having a bilateral discussion. So we are going to solve it with the bilateral or with the mutual understanding, so that you guys must be participating in it, and you will have nice, very good, nice. IFRS 9, yes, it's IFRS 9. It's not IS 39, it's IFRS 9. Very good. IFRS 9, very good. It's an IFRS 9 and convertible bonds or convertible loan notes. Okay. Any one of you, can you please let me know that what accounting treatment is applied for the convertible bonds? Yes, we are here for the revision purpose. Yes, we are here for the recap. We are here for the practice purpose. So, excellent, Muskan. Very good. Nice. Anyone else? What sort of accounting treatment is applied for the convertible bonds or convertible loan notes? It's a split accounting. And what do we mean by split accounting? Yes, anyone? Excellent, Daniel. Very good. What do we mean by split accounting? That we need to recognize both the equity as well as the debt. So in this, we are having a very quick recap of IFRS 9 as well. So I'm not here to just solve the question. I'm here to give you the understanding. Very good, Larib. Nice. Okay. So convertible bonds on 1st April 2015, which means that I think that at the start of the year, yes, 1st of April 2015, and we are having an accounting period. Year ends on 31st March 2016. So yes, it's 1st of April 2015. That is at the start of the year. It means it's the first year of the convertible loan notes. Interest is paid annually in arrears on 31st March each year. Got it? The loan can be converted into equity shares on the basis of 20 shares for each $100 loan note on 31st March 2008. Wait. It means the loan note will be redeemed at 31st March 2008, which means that particular loan note is for the period of 2006, 7, and 8. It means 3 years. The loan note, the period for the loan note is 3 years. Okay. And it will be redeemed at par for cash on the same date. An equivalent loan without the conversion rate is 8%. Now, can any one of you please let me know that what is that 8% and what is that 6%? Yes, please. What is that 8% and the 6%? Yes, anyone? Very good, Hamza. 8% is the effective rate. Nice. And 6% is the coupon rate. Nice. Very good. Excellent. Very good. Very good, everyone. Perfect. Okay. So the present values are given for both the 6% and 8%. Whether the 6%, can any one of you please let me know whether the effect, that is the discount factor for the 6%. Discount factor for the 6%. Is this relevant or irrelevant? Yes, anyone? Discount factors irrelevant. Very good. Because we need the discount factor for the effective rate. That is the interest rate, effective rate, or the market rate. So which means that 8% discount factors are relevant and 6% discount factor is irrelevant. So which means we need to consider that 8%. How? We will see it. Don't worry. Okay. So that was the first adjustment. I told you at the start of the session that if you are having a question in your exams even, you can't say this one, that I don't know anything from this question. I don't know anything. What's going on? I don't know anything from this question. You can't say this one. You can't say this one. If you have studied and you have given lots of effort to that paper, so definitely there will be many things that you would know. There are lots of things that you know. But yes, there might be few things. Please, half of glass is full. It's a blessing. Don't curse on yourself, on the examiner, that why the half of glass is empty. Oh, come on. Please be blissful. Feel blissful that any one of you, if you could say that, I don't know about this adjustment, I don't know, it's a very simple adjustment, and I damn sure from wherever you have studied, from whomsoever you have studied, you must know this one, that how to account for that one. And you just need to do the accounting for the single year only. That's it. You have given the draft profit before the interest and tax, which means the interest expense for the year is not yet been accounted for. Income tax for the year is not yet been accounted for. And you have to adjust it. You have to account it for. You have to account for that interest and the tax. So it means that you need to have an accounting treatment only for the 1 year. Okay, Hamza. Okay, so it means it's not that impossible. It's not that impossible. It's quite simple. Okay, let's read out the another adjustment. Non-current asset. The directors directed to revalue the leased property. It means they have decided that they want to revalue the leased property. Now, okay, let's quickly go back to the trial balance. Do we have property? Yes, here we go. The leased property had an original life of 25 years and the cost was $75,000. $75,000. Okay. Now, let's continue the adjustment. It means it was revalued at $66.3 million on 1st October 2005. First of all, 1st October 2005, which means that accounting period was starting on 1st of April 2005. Accounting period was starting from 1st April 2005 and it's ending on 31st March 2006, which means after April, May, June, July, August, and September, which means after 6 months. After 6 months, that is on 1st of October 2005, the company has decided to revalue the property. Triage company does not make an annual transfer from the revaluation to the retained earning to reflect the realization of the gain. Yes. It's not IFRS 16, it is basically IAS 16. As per IAS 16, if you remember, IAS 16 allows you to transfer the revaluation surplus account to the retained earning account. I repeat, IAS 16 allows you to transfer the revaluation surplus to retained earning account based on the excess depreciation annually. But yes, the other treatment is you can transfer the revaluation surplus to retained earning account at the time of derecognition or at the time of disposal. There are two options that is given by the IAS 16. Here, in this particular situation, here it states that we are going to transfer, we are not going to transfer, does not make an annual transfer. So we are not going to transfer annually. We're going to transfer at the time of derecognition. So far, there is no derecognition, so it means nothing to worry about this one. However, revaluation will give rise to the deferred tax liability at the rate of 20%. Yes. Here, the IAS 12, that is deferred tax. Yes, Fatima, we can revalue the asset. We can revalue the leased asset. We can revalue any asset. We can revalue any asset, whether it's a leased property, whether it's a land, even though the land is not being depreciated. So there is no connection with the depreciation. I think you were taking with respect, you were linking that concept with the depreciation, that if the asset is not being depreciated, so are we going to revalue that one? Yes, we can. So there is no connection with the revaluation and the depreciation. So yes, we can revalue it. Okay. Now the leased property is being depreciated. Leased property means leased building is being depreciated on a straight line basis, which means for the leased property, the depreciation method that will be used is straight line. And for plant and equipment, it means there is another asset, non-current asset, which is being depreciated by using the reducing balance method that is diminishing balance method at the rate of 15%. Now, clarification is being given over here that no depreciation has yet been charged on any non-current asset for the year, which means that for the current year, no depreciation is being calculated. No depreciation is being calculated, which means we need to calculate the depreciation, which indicates that this draft profit, in this draft profit, depreciation expense has not yet been accounted for. I told you at the start of the session, there is nothing impossible in that particular adjustment, I think. Only you have to revalue the lease property and you need to charge the depreciation for two assets, that is the lease property and the plant and equipment. Nice, very good, Hamza. Excellent. This is the situation that in this question, in this adjustment for lease property, depreciation will be calculated in two parts. That is the 6 months before the revaluation and 6 months after the revaluation. Obviously, we are going to do that one. Yes, exactly. 100% right. Now, the third adjustment, which is the second loss adjustment, Let's read out the adjustment. In September 2015, which means after the start of the year, April, May, June, July, August, that is after 5 months, September, the directors of the Triage company discovered a fraud in total 700,000, which had been included as receivable in the above trial balance, which means that fraud, that receivable of 700,000 is included in the trial balance. Let me show you the trial balance and the trade receivables over here. Yes. And note 3 is also given over here. Note 3 is also written over here. Okay. Now, 28,000 is the receivable. It means that 700,000 is included in that trade receivable, which has been included in as the receivable in the above trial balance had been stolen by an employee. Now, the question might came to your mind that how the receivable can be stolen. Because account receivable is something that you need to recover from your customers. So how an employee can steal that particular asset? It's not a cash, it's not an inventory. If you talk about the cash or inventory, yes, that could be stolen by someone, some person or some employee. How a receivable can be stolen? Any one of you? Can any one of you explain this one? You can definitely open your mic as well. So if you want to explain it through a voice note, yes, or you can write it down. Can any one of you let me know that how a receivable can be stolen? How a receivable can be stolen?
So the employee got the money, but he did not deposit to the company.
Exactly. Very good. That employee recovered the amount from the customer, but he didn't deposit that amount by a bad debt. No, it's not a bad debt. Employee recovered the amount, but he didn't recorded that amount. He didn't recorded that values to the company's account. So it means yes, he basically overstated the receivable, or we can call it as the amount was not recorded in the trial balance on the financial statement. Okay, now let's continue that one. 4,50,000 of this is related to the year ended 31st March 2005. And 31st March 2005 is basically the last year, because the current year accounting period is ending on 31st March 2016. That is 2006. But this 700,000, out of the 700,000, these 4,50,000 related to the previous year. It means that is the loss which is related to the previous year. The rest for the current year, which means 750 minus 450, that is the remaining amount is 250, I guess. Yes, 250,000 is related to the current year. The total loss is for 700,000, out of which 450 is for the previous year and remaining 250 is for the current year. The directors are hopeful that 50% of the loss can be recovered from the company's insurer. Now, that is something debatable part, that the company's directors says that we are hopeful that this loss, no, 50% of the loss will be recovered. Remember, there is uncertainty. Directors are hopeful, they are not confident. Now you have to listen me very carefully. Directors are not confident, they are not certain, they are not virtually certain They are hopeful, which means it is possible. No, it's not probable. It's not probable. It's not probable. Directors are hopeful. Remember, if it would be probable, if it would be certain, if it would be virtually certain, if it would be the more chances, the confident. So these are the terminologies that makes you sure that yes, there are high chances, there are huge chances for the recovery of that loss. Here it says that directors are hopeful, which means there are less chances of the recovery. Whenever there are huge or high chances for the recovery, remember, examiner will give you a hint. Examiner will give you some sort of wordings. Exactly, Safwan. Very good. Very good, Fatma. It means that insurance receivable will not be recorded. No, it will not be recorded. Why? Because there are less chances of the recovery. As per IS 37, remember, income or asset will only be recognized if there is a virtually certain. If there are high chances, which means chances are more than 90%. Here it states that the directors are hopeful, which means we are hoping for the best, but from that wording, we can't say that we will recover the amount. And I'm giving you the statement that whenever the examiner wants you to make an entry for this one, so please remember, the examiner will use some sort of wordings or terminologies like the directors are certain, the directors believes that there are high chances of the recovery of the loss. So it means now this is something that indicates that it is virtually certain. Yes, it means if there are no chances of the recovery, so that 700,000, it's a loss for the organization. There is no hope, there is no expectation for the recovery of loss. So that 700,000 should be recognized as a loss. 4,50,000 for the previous year and 2,50,000 for the current year. How it will be accounted for, we'll look into that one. We'll discuss it. Don't worry. Now, the last part, a provision for 2.7 million is required for the current income tax. Now, this last adjustment is for IS 12. And believe me that this IS 12 is quite easy to handle, because in that, whenever you will see the final account question, you will see that there will always be an adjustment for IS 12. And that is quite simple. We all know that in order to calculate the amount of income tax, there are three types of taxes. Any one of you, there are three taxes that should be included. There are three taxes that should be included in order to calculate the amount of income tax. Current tax, very good, Fatma. Prior tax and the deferred tax. Very good, Daniel. Very good, Hamza. Current tax, prior tax, and the deferred tax. And in 99% of the cases, examiner will always provide you with the current tax and the prior tax. Nothing to worry about the current tax and the prior tax. Yes, all what you have to do, you just need to calculate the deferred tax. Now, $2.7 million is required for the current income tax for the year ended 31st March 2006. Any one of you can relate this one, that what is this? What is this information given? Yes, Fatma, very good. Yes, Hamza, it's the current tax which is given in the question. Daniel, very good. The balance on the current tax in the trial balance is the under or over provision of the previous year. Wait. Which means there is some information that is given in the trial balance. Yes, here we go. That is the current tax, which is given on the debit side, 700. If the tax or the current tax is given in the trial balance, say, is this the current tax for the year? No, this is not the current tax for the year. This is the last year tax, because the current tax we are going to calculate, we are going to record it now. Now this is the year that we are going to record that current tax for the year. So it means the current tax which is given in the trial balance, it's a prior tax. It's a prior period tax. And if it is the debit balance, it means it's an under provision. So we need to increase the tax expense for the year, because this is the tax for the previous year. and which is under provision, it means that organization or the company has recorded the lower tax in the previous year. So definitely we have to increase the tax for the current year. We are going to increase it for the current year. Very good, Hamza. Okay. In addition to the temporary differences are relating to the note 2. Wait. Note 2. What was that in that note 2? Okay, let's go back to the note 2. In the note 2, there was a revaluation. And see, here it states that revaluation will give rise to deferred tax, which means there will be a temporary taxable difference. There will be a taxable temporary difference because of the revaluation. Because of the revaluation. I repeat that in addition to the temporary difference, in addition means that other than what we have discussed in the note 2, there is something else. In addition means there is something else. In addition to the temporary differences relating to the note 2, in note 2, there was a temporary difference related to revaluation surplus. There is a temporary difference related to revaluation surplus. And we all know that revaluation surplus will always give rise to the deferred tax liability. Revaluation surplus will always give rise to the deferred tax liability. So it means other than that, revaluation surplus deferred tax, other than that, there is something else. And what is that? That in addition to the temporary difference relating to the information note 2 on 31st March 2006, the carrying amount of the company's net asset, are 12 million more than their tax base, which means the carrying amount is greater than tax base. If the carrying amount is greater than the tax base, this will be known as what? If the carrying amount is greater than tax base, this will be known as what? Taxable temporary difference. Yes. This will be known as what? The tax. It's not the carrying amount. It's not the tax base. It's a difference of carrying amount and the tax base, which means it's a taxable temporary difference. And again, it's not a deferred tax liability. It's a taxable temporary difference, which means at 31st March 2016, the taxable temporary difference is already given. But remember, this is not the only taxable temporary difference at the end of the year. There is another taxable temporary difference, and that was the revaluation surplus. No, it's not included. Just read the information, Fatima. In addition to the temporary difference, stated in the note 2, it means that this taxable temporary difference is in addition to the note 2, which means there are two. Number one, that is the taxable temporary difference because of revaluation, and the other taxable temporary difference is 12 million. Exactly. Very good, Fatma. If, for example, if there had been a statement that the taxable temporary difference or the carrying amount exceeds the tax base of 12 million, which includes the revaluation. So it means that this 12 million is going to be the total taxable temporary difference for the year. But here it is not stated like that one. Here it states that in addition to the revaluation, there is another taxable temporary difference. It's not included. Revaluation taxable temporary difference is not included in that $12 million. Now, these were all the adjustment. But what I believe that there was not any adjustment. That you might think that this will not be able to handle it, or we have not learned it, or we have not practiced it. All of these adjustments are related to few standards, like adjustment number 1 is related to IFRS 9, adjustment number 2 is related to IAS 16, adjustment number 3 is related to I would say it's a general adjustment errors, and adjustment number 4 is related to IAS 12. Now let's read out the requirement, that what is the requirement of this particular question. First of all, you need to prepare a schedule for the adjustments required to draft the profit before interest and tax in the trial balance and to give the profit or loss for the year ended after incorporating the information from 1 to 4. What you have to do, you just need to calculate the adjusted net profit. That's it. In which you have to account for these 4 adjustments. Then you have to prepare the balance sheet for this one. You need to prepare the balance sheet. And then there is a requirement for the DEPS, that is the diluted earning per share. We'll see that one, that how to calculate this one. So first of all, let's start with the A part. That is, we need to calculate the adjusted net profit. For that, how are we going to account it for? Always remember, in order to tackle the question, you need to account for the adjustments first. Yes. Start with the first adjustment, have some working of it, and note down the answer, and then move on to the second adjustment, third, and then we are going to complete the draft profit or loss. Okay. First of all, let me write down the, and now how we are going to present it. First of all, remember that your main answer should be on the front. Yes, main answer should be on the front. Rather, on the right side, there will be a working side. So on the working right side, we are going to have some workings, and the main answer should be on the front. So first of all, we are having a draft profit that is given in the question. Draft profit that is before interest and tax. Draft profit before interest and tax. Okay. Now that is given in the question, and the draft profit is given as 30,000. So we are having the workings in thousands. So obviously, I'm going to put down 3 zeros over here. So 30,000 is the draft profit before interest and tax. Now we have to make certain adjustment. First of all, let's work out for the working one, and this is the convertible loan notes. Convertible loan notes. And now let's recall that how the convertible loan notes will be adjusted. First of all, IFRS 9 states that you need to calculate the financial liability. Yes, you need to calculate the financial liability, because for convertible loan notes, we perform the split accounting, and in split accounting, we calculate both the financial and we calculate both we record both the liability as well as the equity. Liability as well as the equity. Yes, very good. Liability as well as equity. So in order to calculate the financial liability, what we are going to do, we are going to calculate the future cash flows. FCF is future cash flows. And we all know that there are 3 years, that is year 1, year 2, and year 3. Or we can also state the year as well. 2000X6, 2000X7, and 2000X8. Okay. So 3 years, cash flows, future cash flows will always be calculated based on the par value, which means the par value of the loan notes, if I could just see that one, it's 4 lakh bonds or loan notes were issued at $1. So it means if I'm just doing the working on thousands, so 400,000, 400 multiplied by 100. So this is going to be the par value, and we are going to apply the coupon rate. Yes, future cash flow means that how much amount will be paid every year. So every year we pay the coupon rate. So we are going to apply the coupon interest rate, that is 6%. So by this, we have future cash flow for the year 1, same future cash flow for the year 2, and for the year 3, that is the final year, the total amount will be paid to the investor, which means there will be 2 future cash flows. There will be 2 future cash flows. Number 1, that is the 400,000, that is 400 multiply by 100, which means that 40,000 will be paid. 40,000 will be paid. 40,000 will be paid along with the coupon amount. along with the coupon amount. That is 400 multiplied by 100 multiplied by 6%. So it means 42,400 will be paid. Let me show you the formula. Always remember that whatever you are presenting in your in your Excel file, everything should be justified by the working. There should be some formulas, there should be some workings, otherwise your answer will not be acceptable. Please remember, workings are compulsory, formulas are compulsory. So here we have calculated the cash flow for the third year. Now what we have to do? We need to calculate the present value, for we need the discount factor, because we need to calculate the present value of future cash flows. Why? In order to calculate the financial liability. So the discount factor for the year 1 at 8% is 0.93.86 decimal 79. Now we are going to calculate the present value of future cash flow, which is 2400 multiplied by 0.9. And there we have the present value of future cash flows. Now we are going to have a sum. That is 37792. Now this is basically the financial liability. The amount which we have received, that is the proceeds, is 400 multiplied by 100. So that is 40,000. And if you're going to deduct it, so 2280 is basically the equity component. This is basically the equity component. And remember, what IFRS 9 states that future cash flow. How the future cash flow will be calculated? Future cash flow will be calculated. First of all, there will be a par value, because future cash flow means the amount that you will pay, to the in future to your investors. So at the end of the year 1, you will pay 2400. At the end of the year 2, you will pay 2400. At the end of the 3, you will pay 40,000 that you have invested, and for 2400, that is the interest amount or the coupon amount. So total cash flow at the end of the year 3 would be 42,400, and then we have to calculate the present value. Why? Because it's a future obligation, and if we are going to record it right now, so we have to calculate the present value. So we have calculated the present value by multiplying it by the discount factors. These discount factors are already given in the question. Why we have taken the 8%? Why? Because present values are calculated using the effective rate. So we have calculated the present value of future cash flows, and then the financial liability was that is 37792, and we have received 40,000, and 37,000 it's a liability, which means if we just deduct it, so there will be an equity component. And remember, as per IFRS 9, equity should not be restated. Yes, the amount of equity that you have calculated, it should not be restated. In all accounting period, it will be recorded as 2208. But yes, financial liability. If we talk about the financial liability, it will be recorded. If we talk about the financial liability, it will be recorded at amortized cost. Subsequently, it should be recognized at its amortized cost. So one more thing, that if you are doing the working in thousands, so you just need to write it down at least once, that all workings are in thousands. Once you will write it down that all workings are in thousands, all workings or all values in thousands. It's not that compulsory, but if you will write it down, this will not bother you to write it down again, thousands, or 000. So you can definitely work it out. If it is feasible, you can just write down the statement at the start of the question that all values are in thousands. So this will give you a safe side. Now, this is the equity component. Now, what's next? I'm going to prepare the column, or I'm going to work out the amortized cost. I'm going to prepare the amortized cost table 20x6. The first thing is that is the opening liability. The opening liability is going to be 37792. And then I'm going to apply the effective rate. Effective rate is 8%. I think effective rate is 8%. Then I'm going to deduct the coupon rate, which is 6%, which means 37792 plus 3023 minus coupon rate. So the coupon will be applied on the par value, which is 400 multiply by 100 multiply by 6%. So 2400 is the coupon rate, then liability plus effective rate, and then minus coupon rate. So 38415 is the closing liability. 38415 is the closing liability. So we have calculated the effective rate. Remember, what amount of interest expense should be recognized in P&L? Yes, what amount of interest expense should be recognized in P&L? Anyone? What amount should be recognized in P&L? Anyone? Yes, always remember, in P&L, we always recognize the effective rate. We always recognize the effective rate. So we are obviously going to recognize the effective rate. Okay. So that is the working we have done so far. We have calculated the effective rate for the year one that is going to be recognized in P&L. That is going to be recognized in P&L. We'll make the adjustment later on. That is, we are going to update the draft statement of profit and loss. First, try to complete all the workings. Working too. But yes, if in paper, if you think that there is a very less period of time available, or if you think that there's a time challenge, and you think that if you will be attempting for this second working and you will not be able to complete that one, or there is a very less period of time, so you can definitely post it right now, right away. Please don't wait for the end, because this is your end. This is your end right now. Okay, there's a question that at times 2400 is being deducted instead of 3023. No, this is not the case. Always remember that finance cost or the interest expense that will be recognized in P&L, that is 3023. It's not 2400. But yes, what if the examiner states that company's management for example, company's management incorrectly recognized 2400 as an interest expense instead of 3023, or we can call it that company's management has recognized the coupon rate as an interest expense instead of effective rate. It's an incorrect treatment. Now you have to adjust this one. Now what you will do, you will first remove the 2400, that is the incorrect amount, and you will record the correct amount of interest expense, that is 3023, or you can obviously take the difference of it. Yes, Larip, obviously you can get, if you are having workings, and if you, for example, you didn't recorded the amount to your main answer. So if there are workings and with appropriate formulas and calculations, so examiner might reward you with those working, and he will. So it's very important to have workings. Now, working two is for the non-current asset. It's for the non-current asset. First of all, we are revaluing the asset. Now, how do we revalue asset? We need two things. Number one, the carrying amount of the asset and the market value of the asset. The asset that we are going to revalue. So we are revaluing the asset. Name of the asset is leased property and leased property. So we need the carrying amount of the leased property. For that, we need the cost, which is 75,000 minus accumulated depreciation, which means the depreciation. Accumulated means the total depreciation. The depreciation for the previous year is 15,000. Is 15,000. The depreciation for the previous years is 15,000. And remember, here the company is using the straight line method. Company is using the straight line method. So we are going to deduct it. That is 75,000 minus 15,000. Now this is the book value at the start of the year. But we are revaluing the asset in the mid of the year, that is on 1st October. Which means we need to calculate the depreciation for the 6 months, right? Hello.
Sir, it said the reducing balance method in the adjustment two. So why are you doing it a straight line method?
Let's read out the adjustment number 2. Let's read out the lease property. Read the requirement. Read the data properly. The lease property is depreciated on a straight line basis. And the property which is revalued is the lease property. It's not the plant and equipment. Reducing balance method is being used for the plant and equipment. It's not used for the lease property. I repeat, the straight line method is used for the lease property. Are you getting a point? Yes. Yes, recordings will be available. Yes, Hamza, it's a slip of ice. Yes, it's a slip of ice. Good. Okay. So straight line method is being used, and cost minus accumulated depreciation, that is 15,000, but here we have calculated the carrying amount at the start of the year. We need to calculate the carrying amount at the mid of the year on 1st October. So we need to calculate the depreciation for 6 months. Yes, any one of you, please calculate the depreciation for the 6 months and do let me know. Yes, please try it. Let me show you the data. Lease property, the total cost is 75,000. The life is 25 years. Can any one of you please calculate the depreciation for these 6 months? Fatma, please calculate the depreciation again for the 6 months. We are revaluing the asset on 1st October. Which means we are going to calculate the depreciation for 6 months. Okay, let's try to calculate it. Yeah, so far I have calculated the carrying amount, which is 60,000, and it's not the final carrying amount because this is the carrying amount at the start of the year. I need to calculate the depreciation for the 6 months. How it will be calculated? How it will be calculated? Let me calculate it. Although I can also calculate the depreciation in that formula, but let me calculate it over here so that you can see. We are going to calculate depreciation for the 6 months. You just see that how I'm performing the question to that Excel file, showing each and everything, every working. Okay, so the cost of the asset was 75,000, and the life 75,000 is the cost, and the life is 25 years. Yes, it's 25. This will give you the annual depreciation. I need the depreciation for 6 months, so multiply by 6 and divide it by 12. It's 1500. Hello, are you guys getting the point? Okay. Okay, next. Now we are going to calculate the carrying amount. So how we are going to calculate the carrying amount at the date of revaluation? That is 60,000. Let's edit the cell. Let's edit the cell, and obviously we are going to deduct the depreciation for that 6 months, which is 1500. So we're going to link it, and this will give you the carrying amount at the date of revaluation, which is 58,500. We have deducted the accumulated depreciation from 75,000. Larif, just see the calculation. Just see the calculation. You can see the calculation. 75,000 minus 15,000, that is the lease property accumulated depreciation. We have deducted. Larif, are you clear with this one now? Yes, Larif, everyone. So cost minus the previous year's accumulated depreciation minus the depreciation for the current 6 months. It's a slip of calculator. Larry, if someone is having a slip of eyes, someone is having a slip of calculator. Okay, no problem. So there we go. There we go now. So that is the carrying amount. Now, the market value of the leased property, which is given in the adjustment, and the market value of the leased property is that is 66.3 million. 66.3 million. 66.3 million. That is 66,300. And if you're confused that how to write it down, so there's a simple solution. Write 66.3, and if you want values in thousands, so just multiply it by 1,000. 1,000. So it's 66,300. Now, the market value is 66,300. The carrying amount is 58,500, which means that there is a gain on revaluation of gain on revaluation of 7,800. Yes, there is a gain of revaluation of 7,800. One more thing, that after revaluing the asset, we need to calculate the depreciation for the next 6 months. Now, this is something that you have to learn. Now, this is something that you have to learn. That was the depreciation for the first 6 months. Now, let's calculate the depreciation for 6 months, but this time after revaluation. And remember, what is the basic rule of revaluation? That after revaluation, assets will be depreciated at its revalued amount over its remaining useful life. So the revalued amount is 66,300, right? 66,300 is the revalued amount. 66,300 is the revalued amount, and over its remaining useful life. Now, the basic or the important task of this question is to calculate the revalued amount, is to calculate the is to calculate the is to calculate the remaining useful life. Remaining useful life. Yes, any one of you? Any one of you, can you please calculate the remaining useful life? Nice, very good. Anyone else? No, Fatma. Yes. 19.5. Very good. Excellent. How it will be calculated? Let me show you. Let me show you the working for this one. Now see, most of the time examiner will state you that the asset was purchased 5 years ago, 7 years ago, 8 years ago. Examiner will give you. But at times, examiner will not give you that how many years that you have used that particular asset. So for that purpose, examiner will give you a hint, that is the accumulated depreciation which is given over here. And the accumulated depreciation is 15,000, which means that is the depreciation of all previous years. And we are using the straight line method. If you just see that, if you're using the straight line method and we are having an accumulated depreciation of 15,000, now what is the annual depreciation that we are getting? So the annual depreciation that we are getting is 75,000 divided by 25, which is 3,000. So every year we are having a depreciation of 3 years and we have total depreciation is 15,000, which means that the formula to calculate the how many years we have used, accumulated depreciation divided by annual depreciation. I repeat, accumulated depreciation divided by annual depreciation, which means that years used, that how many years we have used that asset is 5 years. So we have used that asset for the 5 years. That 15,000 accumulated depreciation shows that we have already used that asset for 5 years. So that is the number of years. Okay, 5 years we have already used and 6 months for the current year. So in aggregate, we have used 5.5 years. 5.5 years, and out of 25, if we have utilized 5.5, so the remaining useful life is going to be, that is divided by 25 minus 5.5, which will be 19.5. And remember, after calculating this one, we will have an annual depreciation, but we need again the depreciation for the 6 months. So we are going to multiply it by 6 and divide it by 12. So the 1700 is the depreciation for the 6 months after revaluation. First, please do let me know, are we clear on this one? Are we all clear on this one? Please do let me know. Okay, so this is the depreciation that we have calculated for the 6 months. And now, okay, let's calculate the depreciation for the plant and equipment as well. Let's calculate the depreciation for plant, and it is quite simple. There is no revaluation, there is no other adjustment in this plant and equipment. So let's calculate the depreciation for the plant and equipment. Diminishing balance method is being used, and the plant and equipment, the cost of the plant and equipment is 72,100, and the accumulated depreciation is 28,100. 72,100 and accumulated depreciation is, so 72,100 minus 28,100 and multiplied by the rate of depreciation, which is, I think, 15%. Yes, it's 15%. So yes, we have calculated the depreciation for plant and equipment for the current year, that is for the 12 months, which is 6,600. It's impossible. One of the student has asked that if the original life is not given, no, that's not possible. Until and unless you will not be able to calculate the annual depreciation, it's quite difficult to identify it's quite impossible to identify the remaining useful life. Yes, there might be a possibility that examiner might give you direct annual depreciation for the year. Original life is not given, but the annual depreciation is given. So definitely you can apply that formula. You can calculate the remaining useful life. Okay. Now that is the depreciation we have calculated. So now the adjustment number 2, we have accounted for that adjustment number 2. We have revalued the asset. We have depreciated the asset before and after the revaluation, and the plant and equipment is also being depreciated. Now let's move on towards the working for, and the working for is related to some fraud of account receivable. Let's see that what it is. In this, it states that we had a account receivable of 700, and now there's a fraud, and this amount is like a loss to the organization. But here it is stated that 4,50,000 is the loss for the previous year. Now as per IS 8, please remember, if there's a loss or expense for the previous year, which means that last year, I repeat, remember, last year loss was not recorded. I repeat, 4,50,000 loss was not recorded in the previous year because it's a loss. If this amount is stolen, it means it's a clear loss. You have not recorded that amount, you haven't recovered that amount, which means it's a loss to the organization, it's an expense. So it means that loss should have been recorded in the last year, but yes, it was not recorded, which means last year profit was overstated, right? Everyone, please let me know. Which means the last year profit was overstated. Last year profit was overstated, which indicates that the retained earning balance was overstated. So always remember, the last year or the previous year profits or losses will be adjusted in the retained earning, which means that first of all we are going to reduce the amount of retained earning. It means that retained earning will be reduced. Retained earning needs to be reduced. Will deduct the amount from the retained earning by 4,50,000, or we can call it as 450, right? So 450 will be reduced from the retained earning. Why? Because this was the last year loss. This was the last year expense. So it means last year retained earning was overstated, and in order to adjust it, we are going to reduce the retained earning. We are going to reduce the retained earning because last year retained earning was overstated. So we are going to reduce it by 450. Retained earning will be reduced. Further, the remaining 250,000, that is 250, is basically the loss for the year. It's basically a loss for the year, which means obviously this should be charged to P&L. This should be charged to P&L. Exactly. If the loss is not recorded, so we are going to deduct it. Or if, for example, if there had some profit or the revenues which was not recorded for the last year, so obviously we would have increased the retained earning. But here it was the loss, it's an expense, so we are going to reduce the retained earning. And loss for the current year, this will be charged to P&L. And obviously the account receivable is overstated, so we are going to reduce the account receivable. We are going to account receivable will be reduced by 700. Account receivable will be deducted and it will be adjusted by 700. So far, if we are adjusting the profit, so definitely account receivable and retained earnings are irrelevant. Yes, Hamza, very good. Now, last adjustment that is related to income tax, and we are going to calculate the income tax. Accounts receivable, there was a loss of 700,000 which was not recorded, which means that loss was not recorded, and this account receivable balance is still there in the financial statement, that is account receivable in the trial balance. Now 450 is related to the last year, that is the previous year, and remaining 250 is for the current year. So if there is a loss for the previous year, so it should be adjusted in the previous year. Now how are we going to adjust it? So it means if the loss was not recorded in the previous year, which means the profit for the previous year was overstated, and we all know that then all the profits are transferred to the retained earnings. So which means that the retained earning for the previous year or the opening retained earning is overstated. Now we have to adjust that retained earning balance. And how are we going to adjust it? We are going to reduce, we are going to deduct that retained earning amount. We are going to reduce that retained earning amount. Are we clear on this one? Hello everyone. We'll show it. We'll show it. This is the depreciation for the plant and equipment. Cost 72,100 minus accumulated depreciation that was given in the trial balance 28,100, and then we have applied the percentage 15%. Okay, now. So let's move on towards the last adjustment, that is working 5. And in this working 5, we are going to calculate the income tax. Because the profit which is given in the question is before the interest and tax. So income tax, we have 3 taxes. Number 1, the current tax. The second one is the prior tax. And the last one is the deferred tax. So the current tax that is already given in the question, which is 2.7 million. 2.7 million, which means that it's 2,700. Then we have prior tax, which is given in the question, which is given in the trial balance, which is 700 debit balance. And debit balance means that it's an under provision. So we are going to increase. We are going to increase the income tax for the year, which means it will be added. If it had been a credit balance, so we must have deducted, which will reduce the income tax for the year. Now, the main task is to calculate the deferred tax. How it will be calculated? For deferred tax, the opening deferred tax liability is already given. This is the deferred tax liability opening balance, which is already given. That is 3,200. That is 3,200. It's a deferred tax liability opening balance. Okay, if we just calculate, if we just make a ledger for this one, for example, that is the credit side and 3,200 is the credit side. It is basically the opening balance, deferred tax liability opening balance. And now, there is a closing balance which is given over here, that the carrying amount exceeds the tax base by $12 million, which means that at the end of the year, the carrying amount is greater than the tax base. First of all, what is that 12 million? What is that 12 million? What is that 12 million? Very good. Is it for the year or at the end of the year? Taxable temporary difference at the end of the year, or yes. No, it's not for the year, Fatma. It's at the end of the year. Just look at this. That at 31st March, it's not for the year. At 31st March 2016, which means it's a closing. It's a closing. Yes, at the end of the year. There is a 12 million taxable temporary difference, which means this shows the closing balance. And remember, this is the ledger for the deferred tax liability. It's not the ledger for the taxable temporary difference. So we are here, we are having a ledger for the deferred tax liability. So it means that 12 million, yes, 12,000, and will apply the tax rate to calculate the deferred tax liability, and the tax rate is 20%. Tax rate is 20%, which is given in adjustment number 2. Yes, tax rate is 20%. So 20%. Now, this will give you the deferred tax liability closing balance. But remember, this is not the only deferred tax liability closing balance. There is another deferred tax liability. There is another deferred tax liability. There is another taxable temporary difference, and which is related to revaluation. So we had a revaluation gain, we had a revaluation surplus. Yes, we had a revaluation gain, or we had a revaluation surplus of 7,800. Yes, we had a revaluation surplus of 7,800. So I've just linked that cell, and on that we will calculate the tax rate, that is 20%. This will also be included. You can see the formula bar. You can see the formula bar over here. 12,000 in times 20%. Why? Because that 12,000 is the taxable temporary difference, and we will apply the tax rate. Yes, that's perfectly fine. Yes, very good. 12,000 plus 7,800 in times 20%. Perfectly fine. Excellent. Excellent. This is also a simplest way to do that one. Very good.
Sir, I have
Very
a
good, Khalid.
question.
Yes.
Sir, in deferred tax liability, we make a ledger, right? So
Yes.
in the revaluation surplus adjustment is done on the credit side. So can't we just
Yes.
do that? Will it give the same answer for the deferred tax liability?
Okay. You want to eliminate it from here, from both the sides?
I'm just saying that in a ledger, like we make a ledger, we write brought down, we write tried down, but in
And
the
now
credit
we have a
side,
revaluation surplus here. We have a revaluation surplus. Why? Because the revaluation surplus deferred tax liability, the entry would be, that is the deferred tax liability, revaluation surplus will be debited and deferred tax liability will be credited. Remember that in IS 12, whenever we are having a deferred tax on the revaluation surplus, so the deferred tax entry for that one would be revaluation surplus will be debited and deferred tax liability will be credited. Revaluation surplus will be debited and deferred tax liability will be credited, which means that revaluation surplus, deferred tax on the revaluation surplus will be credited to deferred tax liability. Will be credited to deferred tax liability, which means that 7,800 in times 20%. 1560 will be recorded on the credit side. Remember, whenever we are having a revaluation surplus, so always remember that deferred tax on the revaluation surplus will be charged to revaluation surplus, which means revaluation surplus will be debited and deferred tax liability will be credited. So there we had a deferred tax liability ledger, opening balance on the credit side, closing balance on the debit side, and then we had a revaluation surplus on the credit side. Now
um,
let's try to
sir,
calculate
my
the
question is, why did you add the carry 20% carry down in the carry down?
because always remember, everyone, listen to me very carefully. Deferred tax on revaluation surplus. Everyone, please repeat the sentence with me. Deferred tax on revaluation surplus. Deferred tax on revaluation surplus will be the part or will become the part of your closing liability. It means that whenever you want the deferred tax liability closing balance, whenever you want the deferred tax liability on the closing balance, whenever you want to calculate the deferred tax liabilities closing balance, there will be two components. Number one, the other taxable temporary difference and the revaluation surplus. Deferred tax on revaluation surplus will become the part of your closing balance. Deferred tax on revaluation surplus. Deferred tax on revaluation surplus. Deferred tax on revaluation surplus will become the part of your closing deferred tax liability. will become the part of your closing deferred tax liability. So whenever the examiners ask you to calculate the deferred tax liabilities closing balance, so remember, there will be two things. Number one, the other taxable temporary difference, as well as the deferred tax on revaluation surplus. That's why in order to calculate the closing balance, what I have done, that I have taken the deferred tax on the other taxable temporary difference, that is 12,000, and then I have also calculated the deferred tax on the revaluation surplus. Now we are going to calculate the difference. If you just see that on the credit side, there is an amount of I think 4,760, and on the debit side there is 3,960, which means the debit side is shorter, which means that debit side is shorter. So which means that if the debit side is shorter, so what we are going to do, we are going to have a balancing figure on the debit side, which is 800. And whenever, remember, whenever there is a balancing figure on the debit side, it's not an expense, instead it's an income. Accounting entry for this one would be deferred tax liability is debited and deferred tax expense is credited, which means expense is credited. That shows that expense is reduced, and if the expense is reduced, which means the profit will increase, so it will be recognized. Yes, it will be recognized as an income. So we will have a minus sign for this one, that is minus 800, and then we are going to sum it to calculate the total income tax expense that should be reported in P&L. That is 2,600. Okay. Whenever there's a question that how we'll know whether is it the given closing deferred tax liability or for the year. If it is written, okay, let me show you the statement. Let me show you the statement. If it is written over here that in addition to the temporary differences relating to the information in note 2, the carrying amount, listen to me very carefully, the carrying amount of Triage company's net assets are 12 million more than their tax base for the year. For the year. So it means that it is the taxable temporary difference for the year. It's not a closing balance then. Then it's not a closing balance. But here it states that at 31st March, which means that at the end of the year, the closing amount, the carrying amount of the Triage company's net assets are 12 million more than their tax base, which means that it is the balance at the end of the year. Are you getting my point? Which means that is the balance at the end of the year. This is not for the year. This is not for the year. If it had been for the year, so examiner must have stated that the carrying amount exceeds the tax base for the year by 12 million. For the year by 12 million. So it means that would be considered as the deferred tax liability for the year. Right now, it's not for the year, it's at the end of the year, it's a closing balance. Okay. Now, what we are going to do, what we are supposed to do now, we are going to adjust the profit. First adjustment that we need to make an account for, that is the interest expense for the year. And then we have to obviously incorporate the income tax, and we have depreciation expense as well. Okay, let's try to put it down. Interest expense, that is interest expense for the year 1, that is going to be accounted for is 3023. 3023. The cell number is K16. K16, and it will be deducted K16. So minus K16. Now, another adjustment, that is the income tax expense. The adjustment for the income tax expense, that is 2600. It's K47. It's K47. So minus K47. And Another adjustment that we need to account it for is the depreciation expense. So the depreciation expense, yes, we have the depreciation. So let's calculate the total of it. Is 9,800. It's K30. K30 minus K30. Because these are the expenses, so these will be deducted. These will be deducted. Okay, now any other expense? Any other expense of P&L? Gain on revaluation, it's a revaluation surplus. Okay. Fraud, yes, here we go. The loss for the year is 250. The loss for the year is 250. Yes, fraud. It's K37 minus K37. Loss on accounts receivable. Any other expense? No, we have incorporated all expenses. So let's calculate the adjusted net profit and 30,000 and all these adjustments. The bracket will be closed. So 14326. 14326. It is basically the adjusted net profit. It is basically the adjusted net profit after interest and tax. Now, this was the first requirement, and the second requirement is that you need to prepare the statement of financial position. And remember that since you have done all the working, so now nothing to worry about it, because now the balance sheet would be quite simpler for you. So let's calculate, or let's prepare the asset side. And asset side, we have multiple assets, like first of all, we have the leased property. Now, leased property, and leased property is being revalued. Leased property is being revalued, and we have already done that. Now the leased property is being revalued to 66,300, and obviously the depreciation for the last 6 months will also be calculated. So 66,300 minus the 6 months depreciation was, that is 1,700. So it means the carrying amount of the lease asset is 64,600. Then we have plant and equipment. So the working we have already performed. So the carrying amount of the plant and equipment was 72,100 minus the plant and equipment accumulated depreciation was 28,100, and the depreciation for the current year. And the depreciation for the current year, that is 6,600. So this has also been adjusted. Any other asset? Now we have some other current assets. Other current assets, and the values will be posted directly. That is 9,300. Then we have another asset, which is accounts receivable, or we can call it as trade receivables. Now the trade receivables were 28,000, out of which 700, yes, 700 is now deducted. Why? Because of loss of account receivable. So we have deducted that 700 from the trade receivables. Okay, any other adjustment that you guys see, that you guys can see in this particular question? Any other adjustment, any other asset that is? So let's sum all the assets. It's 1,38,600. That is the total assets. Now let's move on towards the equity side. Now in equity, we have equity capital, which is already given, that is 50,000. Okay, now another thing, that is a retained earning. But yes, for retained earning, please remember, retained earnings for retained earnings. The opening retained earning balance that is given over here is 3,500. First of all, you need to transfer the profit. You need to transfer the profit after tax, because remember, all the profits are transferred to the retained earnings. So we have added that profit, and now we are deducting the last year adjustment. The last year adjustment, that is the retained earning 450. That was the loss for the last year. So we are adjusting that retained earning. Why? Because this retained earning is overstated. So we have deducted that 450. Retained earning balance was 3,500. Plus 14326 minus that is 450. Then any other asset, any other equity? Yes, please. Anyone? Is there any other equity? Is there any other equity in the question? IFRS 9 equity. Very good. Excellent. There is another equity that should be accounted for, and it will never be restated. Equity as per IFRS 9, which means convertible bond. Convertible bonds related equity, and which we have already calculated. And what is the amount of that equity? It's 2208. Very good. Nice. Anything else? Yes, please. Equity. As far as the equity is concerned, is there any other equity balance? Is there any other equity account? Revaluation surplus. Very good. It's revaluation surplus, that we have revalued the asset. Although this information was not given in the trial balance, but yes, we have a revaluation surplus. And the revaluation surplus that we have is 7,800. But remember that from this revaluation surplus, we are going to deduct the deferred tax on revaluation surplus. Because remember, the deferred tax on the revaluation surplus will be deducted. Why? Because the deferred tax on the revaluation will reduce the revaluation surplus. This will be charged to revaluation surplus. Okay, so we have calculated the revaluation surplus as well. Anything else? Now let's move on towards the liability side. And if you are having a liability, so just look at the trial balance. The first liability is convertible bonds. 6% convertible bonds or loan notes. Are we going to write down the liability with 40,000? Yes. Anyone? What is going to be the liability? What amount of liability should have been recorded? Yes, please. Are we going to write down 40,000 in the liability? 37792. No. This 38415. Very good, Fatma. 37792 was the liability at the initial recognition. We are preparing the balance sheet at the end of the year. So which means the liability of 38415 will be recorded. 6% convertible loan note, 38415.36. Then any other liability that we have. Let's try to recall the trial balance. No, these are the assets. And then we have current liabilities. Okay. Then we have deferred tax liability. Yes. Deferred tax. Any one of you. What is going to be the deferred tax liability? Deferred tax liability. Let me show you the working. What is going to be the deferred tax liability? What will be the amount of deferred tax liability? 3960. Very good. Remember, in balance sheet, we always recognize the closing balances. We always recognize the closing balances. I repeat, we are recording the liability. First of all, we have convertible loan notes. Convertible loan notes will be recognized at its amortized cost, which means at the end of the year. So liability for the convertible loan note would be the closing balance of the table that we have already taken. Now we have deferred tax liability. Deferred tax liability that is given in the trial balance is the opening deferred tax liability at 3,200. We always recognize the assets and liabilities at the end of the year. So the closing deferred tax liability is 3960. 3960. Garib. 3960. That is M48. Now another liability that we have is the current tax payable. Please remember, with respect to the income tax, two liabilities will always be recorded. Number one, deferred tax liability. Number two, current tax payable. That's it. Remember, for prior tax, we will not incorporate in the liability, because prior tax is the tax of a previous year and which is adjusted during the year. So prior tax will not create a closing balance of the liability. Only two liabilities will be recorded. Number one, deferred tax liability and the current tax payable, which was already given in the question. Current tax payable, which was already given in the question. And the current tax payable was 2,700. Current tax payable was 2,700, which was already given in the question. So there will always be two liabilities will be recorded for taxation. Number one, the deferred tax liability, and number two is current tax payable. Yes, any one of you, is there any other liability? Is there any other liability that needs to be accounted for? Yes, please. Here is the current tax, that is 2,700. No calculation was required because this was given in the question. Where it is given, let me show you here. The provision of 2.7 million required for the current income tax on the profit for the year ended 31st March 2006. Okay. Now let's total it. We are going to sum the complete balance sheet, that is from the equity till the liability. I think current liability, we haven't recorded the current liabilities for the year. Yes, here we go. The current liabilities is 7,700, 17,700. Current liabilities is 17,700. So here we go. That is the 1,38,600 is the total equities and liabilities. So the total assets is 138,600 and total equities and liabilities is 1,38,600. Are we clear on this one? Now the last part of this question, is that we have to calculate the, obviously we are issuing convertible loan notes and can potentially dilute the basic earning per share. So calculate the diluted earning per share. As per IAS 33, there are two ratios basically that we need to calculate: EPS, that is earning per share, and the diluted earning per share. EPS states that how much amount of profit you have for the per share. Earning per share, for that the simplest formula is, that is the profit after tax divided by weighted average number of shares. And since you are calculating the earning per share, for example, earning per share is $2, which means $2 per share. So it means companies are having an earning of $2 per share, that if the total earnings are distributed among the shareholders, so every share, and on every share you will be getting $2. Obviously company will not divide, or company will not distribute the complete profit, but this is something the investors calculated, that how much amount of profit we are earning on per share. Now one more thing, that if we are calculating the earning per share, so there is a concern that in future what will happen that you are issuing the convertible bonds, and what will happen if you're issuing the convertible bond, that after 3 years, obviously after 3 years, the convertible bond will be converted into equity. Now there will be an impact, on the EPS, not now, but after 3 years there will be an impact. So an investor wants to analyze that what will be the impact, what will be my diluted EPS. Diluted means reduced EPS. When? After 3 years. When? After 3 years. So it means that if in situation the shareholder or the investor will opt the option, and the convertible bond, which is right now a liability, will be converted into equity, so this will obviously affect your EPS. So investor wants to calculate that EPS. So that EPS is known as what? Diluted EPS. Now we are going to calculate the diluted EPS. In order to calculate the formula, in order to calculate the diluted EPS, so the formula is diluted earning per share. So the formula is that obviously we are taking the profit after tax, and then we are going to deduct, basically profit after tax, and we are going to add up the interest saved. Why? Because if the investor will opt the convertible bond as an equity or shares, so it means that if this bond will be converted into equity, so you will save some interest. It means the interest that was due every year will not be in will not arise. So it means your interest will save. So what we are doing, we are calculating the diluted EPS with the mindset that what will happen, that is for the future. So if the bond will be converted, so it means there will be no bond, there will be no liability, there will be no interest. So it means interest will be saved. And if the interest will be saved, it means expense will reduce and the profit will increase. So we have increased the interest saved. Now, obviously, if you will save the interest, your profit will increase. And if your profit will increase, you will have to pay a tax on that one. So we are going to deduct the tax here. Tax on what? Tax on the interest saved. Please remember, we are not going to calculate tax on the profit after tax. No, it's already deducted. Profit after tax means the tax has already been deducted. We are calculating the income tax. We are calculating the tax. We are calculating the tax on the interest saved. So this is going to be the formula number one. And we are going to divide it by number of shares. We are going to divide it by number of shares. Total number of shares that is after the conversion. What will be the total number of shares? What will be the total number of shares? What will be the total number of shares? We are going to divide it by what will be the total number of shares. Are we guys getting the point? Yes, exactly, Hamza. Very good. That is the maximum number of shares to be issued, and that is the information which is already given over here. We are going to apply it. Don't worry. So shall we continue now? Okay. Now, first of all, let's calculate the profit after tax. Profit after tax, we have already calculated. We have already calculated the profit after tax, and here we go. That is 14326. That is the profit after tax. Now we are going to increase the profit with the amount of interest saved. So the amount of interest that would be saved is, we have already calculated that is 3023.36. that is the amount of interest that will be saved in future. So it means we are going to add it. We're going to add it because this will increase the amount of profit. When the debentures or the loan note will be converted, it means there is no need to pay the interest. There is no need to arise. There no interest will be incurred. So it means this will increase the amount of profit. But now, yes, one more thing, that this profit, sorry, that is the profit after tax. Yes, here we go. And then we are going to add it, the interest saved, and which is 3023.6, and then we are going to deduct the tax on this profit or tax on this interest. We are going to deduct tax on this interest. Then how it will be done? And okay, we have added the interest, and this is not the end. Now what we have to do, the interest that we are going to save, obviously there will be a tax on this particular interest. So we are obviously reducing it by deducting the income tax. So income tax will be calculated on that interest. So K16 in times 20%. K16 in times 20%. Now, what is the formula? That first of all, we have taken in C11, which is the profit after tax. We're going to add up. What we are going to add up? The net amount, basically. The net amount. K16 is the profit after tax. K16 is basically the interest saved. K16 is basically the interest saved. That is 3023. And then we are going to deduct the income tax on that particular interest saved. So 16745 is going to be the profit after tax, and profit that will be in future. Let me show you the calculation again. You can definitely split that calculation into different steps. What I've done, I have made all the calculations in one formula cell. You can definitely split that calculation into different cells, into different steps. First, you may take the profit, and then you add the interest, and then you may deduct the tax expense. Let me show you the working in detail. Okay. Let me show you over here. Okay. That is, we have first of all the profit after tax, which was 1436, and then we are having an interest saved. So we are going to add it. That interest saved, the interest that we have saved is in the formula, in the cell number 3023, that is K16. K16. So let's do it over here. So the total profit that would be this one. But now we have to tax And remember, we are not going to tax the whole profit. No, we are going to tax the only interest amount. Interest amount. So it means 3023 in times 20%, and I'll be taking it with the minus sign because I want to deduct that tax expense. So it means now the if I just calculate the net amount of profit is that is same 16745. So you can definitely split your working into different steps. Yes, exactly. You can do that one. You can also take the 80% of 17350. But no. You cannot take 17350. Please, if you will take the 80% of 17350, it means you have also taxed the profit after tax. Please don't take the 80% of 17350. Otherwise, it seems like that you have re-taxed that 14326. It is already taxed. We have already calculated the income tax. So you just need to calculate the income tax on that interest amount. So that's why I have deducted that income tax. Look at this. I have calculated that income tax on the interest amount only. Fatma, are you getting the point? Good. So this is something that we have calculated. Now we need number of shares. Now we need the number of shares. Okay, number of shares. For number of shares, we have already 50,000 number of shares, I think. That was given in the question. Yes, 50,000 is the ordinary share capital. $1 is the par value. So we have 50,000 ordinary number of shares. Additionally, additional shares that will be issued. Additional shares that will be issued when? At the time of conversion. So here it is the data that is given in the first paragraph that company issued 400,000 $100 convertible loan notes. Company issued 400,000 $106% convertible loan notes. It means the company has issued 400,000 loan notes. And now it is stated that the loans can be converted into equity shares on the basis of 20 shares. It means against 400,000 loan notes, the company will issue 20 shares of $100. We have 400,000 convertible bonds. 400,000 convertible bonds divided by 20 shares will be issued at the rate of 11, sorry, at the rate of 100. So which means this amount of shares will be added, or this amount of shares will be increased. Let me show you the formula. The company has already issued convertible loan notes of 4 lakh. 4 lakh convertible bonds are already issued. Hello, can you guys hear me? Hello, am I audible now? Hello, everyone. Can you guys please acknowledge me that am I audible now? Hello. Okay, great. Okay, let's repeat that what we were doing, that we are going to calculate the convertible bonds that will be converted into ordinary shares. We have already 50,000 ordinary shares. 50,000 ordinary shares. That means that we have 50 million ordinary shares in bank. Now we are going to issue additional shares. Now what is the criteria? That we are going to issue 400,000. We are going to issue 400,000. We have already issued convertible bonds of 400,000, valuing $100 each. So if we just calculate the 400,000, that is multiply by 100. So it means that this is going to be the total amount, that is 40 million. It means that the convertible bonds is of a 40 million. 40 million. And if you're just doing a working on 1,000, so we can definitely eliminate 3 zeros. So if we just calculate it and we'll make it simpler. So that is 40,000. Now listen to me very carefully, which means the value of the convertible bond is 40,000. Now what is the criteria? The criteria that is given over here, that the convertible bond that will be issued is 20. That on that convertible bonds, 20 shares will be issued. 20 shares will be issued. 20 shares will be issued, which means that 20 shares will be issued. 20 shares. We are going to issue 20 shares. That is multiplied by 20 and divided by 100. So this will give rise to 8,000 shares. That is 8 million shares. Let me repeat it again. That the convertible bond that we have already issued is 400 and the value of the convertible bond is $100 each, which means that is 40 million convertible bonds that we have issued. Now what is the requirement? What is the requirement of this? That we are going to issue 20 shares. We are going to issue 20 shares. So multiply by 20 divided by 100. So this is something that we have got, that is 8,000 additional shares. So 50,000 shares that we have already here, and 8,000 there are additional shares. So the total number of shares after the conversion would be, that is 58,000. Now we are going to apply the formula. The formula was, that is the profit after tax plus interest saved minus tax, that is 16,745, divided by the maximum shares that will be in future is 58,000. So the the DEPS, that is the diluted earning per share, is $0.28, or we can write it in terms of cents. In order to write it in terms of cents, we can also multiply it by 100. So it is 28 cents. You can also write it $0.28. And if you want to call it in cents, so this will be multiplied by 100. So this is the diluted EPS. I hope that you guys got the concept of it, that how it will be solved. So this was the complete question that was related to final account. And again, I urge you to please practice it again and again. Practice more questions so that you will get the idea. And again, I would repeat that in final account question, there is nothing new, but what we have already done, what you have already done in the previous standard, you just need to apply those standards to that question. You just need to apply those concepts to that particular standard, to that particular question. And more you are comfortable with the standards, obviously you can handle the final account questions at your ease. So please practice it. If you feel any difficulty or if you want to ask anything, you can definitely reach me out. I'm just a message away, so I can definitely I will definitely try to help you out in your difficult situation. Thank you so much for joining this session, and we will have more sessions in upcoming days, so please stay tuned. Thank you so much.